We've just come off a week of massive volatility. We're worried about a US recession. We've got sort of Chinese data we're trying to fold into the mix as well. Europe looks like it's doing its own thing. What are you looking for this week to provide clarity?
Yeah, morning, Guy. So I think that there are a few market indicators that we'll want to pay particularly close attention to, given this sort of slight ratcheting that we're seeing and concerns about the US economy and the growth outlook, and whether indeed, people are getting more worried about a recession. One of them, the Treasury yield curve, pretty important. Looking at that sort of bull steepening that we're seeing, where we're seeing short-term interest rates fall quicker than long-term interest rates, which means that people are betting both on a slowdown and on the idea that the Fed is going to have to cut more aggressively. Have a look at junk bonds yield spreads in the US as well, widening out quite aggressively over the past couple of weeks, pushing to multi-month highs again, showing a little bit of stress there that hadn't really been on the radar too long ago. And then, of course, in the retail space, I think the sentiment there is really important at the moment. We're seeing that show up in the declines in cryptocurrencies that we've seen over recent weeks, and in some of the survey data as well. So the American Association of Individual Investors found that for the first time since 2022, more people in their survey thought that stocks would be lower over 6 months than they would be higher. So that sentiment is definitely starting to shift, and I think that some of those metrics may give you more insight into exactly what the market sees as coming next.
Paul, we're headed into a week full of data, as Guy had mentioned. I'm looking at a 10-year at 427 over in the States. How low can yields go? What kind of data print do we need to see a bigger drop in yields?
It seems like people are quite worried about the data, quite worried about the economic surprises coming in to the downside. And, on the flip side of that, of course, you've got in the back of your head the worries about inflation that might hold up bond yields. And that's why we're seeing a little bit of that steepening there of the yield curve. It feels like the other thing that you've got to factor in mind is just sort of the overall risk and economic tension and stuff like that. But on the other hand, if you look at what the Fed's been saying, they've been saying we're quite happy to hold interest rates here. We heard it from Powell. On Friday, we heard it from Mary Daly as well. Quite a strong message that they're not preparing to move interest rates anytime soon. So that may prevent yields from falling too aggressively from the here.
Paul, just in our last 30 seconds, let me ask you guys' favourite question. If we see the US stock market continuing to fall, how much does that spread over into Europe?
That's really interesting, isn't it? You would expect, all things being equal, that if people were really worried about a US recession, that would at some point start to impact the rest of the world as well. I'm not seeing it so far. We're seeing European futures up for today, for example, still buying into that growth story instead. I think, people will get more worried about this if that pressure continues to ratchet up, and then it will start to spread.